Hey guys, this is Vu here. So last time I made a video on the 50-year mortgage and how you could actually save $1 million more than a 30-year mortgage, even if the interest rate is slightly higher. And this was all due to the power of compound interest by reinvesting your monthly savings into the stock market. But that video doesn't address the biggest criticism of the 50-year, which is that for most people, especially first-time home buyers who are in their 30s and 40s, they will not live long enough to fully own their homes. Completely fair point. So today, we're going to explore whether the power of compound interest can allow us to fully pay off our 50-year mortgage even before the 30-year mortgage without contributing anything extra. So let's take a look. So first things first, we're going to go to my website at cookcountytaxcompare.com right here. And we're going to go to the loan maturity tool. So we're going to select $500,000 as an example for 30 years. At 6%. So remember that the monthly payment is going to be $2,998. And if we were to select the 50-year and increase the interest rate to 6.25, then the monthly payment is going to be $2,725. So only saving you $275 per month. Now, I pre-populated an Excel workbook just to demonstrate some numbers. So remember, $500,000, 6%, 6.25%. Now, the 50-year monthly payment, we can actually do the PMT formula. So PMT is just the payment formula, and it's just based off some algebra and geometric series where you can calculate the monthly payment taking into account the increase in the amount you owe because of interest. So we're going to do PMT 6.25% divided by 12 because we're going to do the monthly payment. And we're going to do end period, means the number of payment periods. We're going to do 600 because that's 50 years. There's 600 months in 50 years. And the PV means present value. So we're going to do $500,000. And then we're actually going to do the negative of that. So that's how we get this $2,725 from earlier in this calculation based off the PMT formula. And the 30-year, we're going to do exactly the same thing. So it's equals PMT. The rate is 6% divided by 12. Number of periods is 360 because there's 360 months in a year. And then we're going to do the future value, $500,000. And don't forget the negative of that. So that's how we get this $2,998 from earlier. And your monthly savings is just this minus this, $273. Now, we're going to actually utilize the power of compound interest. So let's put the stock market rate at 9%. We're going to take a look and do the calculations on how much of this $2,725 are interest and principal based from the loan. So this is how we're going to do it. This interest is basically this $500,000 times this 6.25 divided by 12. So your first month payment of $2,725, most of it, vast majority of it will be interest. And the principal is just going to be this amount. We're going to put a dollar sign next to it to freeze it, minus this amount. That's only $120 goes to the principal. And then we're also going to freeze this as well. I5. All right. And then your loan remainder is basically just this value, this $500,000, subtracting the principal. So $499,879 left. And so we're going to do that for all the way down. So I just pulled the formula all the way down so that the interest can take into account, instead of the $500,000, where it's interest of the $499,879. And then so the interest each month will start decreasing while the principal over here will start increasing, just like how would happen when you pay off your loan. So at the end of the 600 months, which is 50 years, we should have zero remaining. The vast majority of it is principal and very, very little interest. So this is how banks calculate your interest and principal. And so the other thing that we're going to calculate is the savings from the 50 year. So basically what this is if you're to reinvest your $273 monthly savings into the stock market of 9%, what would you save? What would the amount be after so many months? So let's take a look. So what we would do is do equals this $273, and we're going to freeze it by putting some dollar signs next to it, which means that we're going to freeze that cell, times 1 plus this 9%. We're going to put a dollar sign next to that to freeze it, and then it's going to be for 12 months. So we have to divide it by 12 because the 9% is a yearly amount. And then we are going to the exponent of the amount of months, and we are going to subtract 1 from it, because the first month's payment you're going to save, and so it's not going to be calculated yet. You're not putting it into the stock market yet until you made your first payment. So you're going to put $272.89 in the first month into the stock market. And after 1 month, that $273 becomes $275, and so on. It becomes $277. So this first payment becomes this $277, while the second month, it becomes $274.94, and the third month becomes $273, if you're looking at it from the third month's perspective, because the third month has not grown anything yet. So the way this works is that it's going to be inversely related to which month it is. So let's take an example. On the 12th month right here, your first contribution to your savings, your first investment of $273 becomes $296.27. Your second month of $272.89 becomes $294. And then your third month's $291, your fourth month's $289, your fifth month $287, and so on. So it's inversely related. And then we are going to do a calculation of the running savings. So basically, the running savings is at whatever months you want to take a look at, how much is your $273 that you've been contributing every month, how much has it grown to? So we're going to do an example. Sum of this. We're going to have to freeze this first amount. So, for example, we're going to do it, and the running savings at the 12-month mark, all those $273 that you put into the stock market, after 12 months, it's grown to be $3,413. But if you were not to invest in the stock market, it would actually only be $3,274. So you actually gained this amount, $138, from investing your monthly savings in the stock market after a year. And so we're going to keep doing that. And this is the running total. So how this is going to work is we're going to find out where the savings that you have is equal to the amount of mortgage remaining in your mortgage. So if we go all the way down here, so remember, your loan remaining is this field, and your running savings is this field. So where this value equals this value, that's where we could pay off our loan. So if we scroll down all the way to right about right here, somewhere between the 330th month and the 331st month, they are equal to each other. So let's do this right here, this right here. So in your 331st month, your savings from the stock market at 9%, it outgrows your loan remainder, your mortgage that's left over. So you could pretty much pay off your loan in the 331st month. And remember, 30 years is 360 months down here. So you are actually paying off 30 months earlier than if you had selected the 30-year. Now, let's say you actually want to pay off your 50-year loan after 30 years. Your loan savings would actually be this minus your loan remainder. So you would actually have $127,000 left over if you selected that route. So I wanted to add an addendum to this video so that I could add some plots and charts, because I think that would allow us to visualize things a little bit better. So in here, we click Insert, Recommended Charts, and then we select this chart. So in here, so we select a chart with the title. We can see that the line, this blue line right here, is the loan remainder. And so this is our remaining loan when we first bought it at $500,000. And this green line is our savings, our $273 per month savings by selecting the 50-year and reinvesting into the stock market. So we see that after 330 months, the lines cross. So we're gonna zoom in a little bit. So down here, this is where the lines cross, where our savings actually outperforms and is growing exponentially and is higher than our remaining loan. So we can see that this is the power of compound interest. And after 360 months, which is right over here, our savings is much higher than our loan remainder, and this is the $126,000 that we saw earlier. And this is the power of compound interest, and this is to show you that the 50-year mortgage, if you select it and the interest rates are roughly around each other, or for the 50-year slightly more, you could actually save more money by reinvesting your monthly savings in the stock market. So you could either pay it off the loan 30 months early by selecting the 50-year, or you could save $126,000 extra by just reinvesting in the stock market and paying it off after 30 years. So this is Vu. I hope this has been insightful. Please like and subscribe, and you guys have a good day. Bye.